Okay, good. What I'll do is I'll do a quick overview, and then I will go into some demonstrations. I pulled up some websites for you all, so you can see where I go to get my information. You can also connect with me. I think Monica has my contact information, but if you want to send me a text to 415-713-0213 and give me your name, and then you can connect to me on LinkedIn, just so I know who you are. I don't connect with everybody, but if I know your name, I will connect with you. I post probably 10 to 20 articles per day that I push out on economics and demographics. I try to stay away from the politics, but if the politics or political economy and have an impact on individuals or have an impact on the economy, I will post the political analysis. So it's a good way to keep up to date and to be abreast of what I think is important, and what I track and what I monitor economically, politically, demographically, geopolitically, and in the real estate markets. So 415-713-0213. My email is Souza, Souza, at johnsonsouzagroup.com. You can also go up to my LinkedIn. My contact information is there. You can also Google me and find me that way too. Monica had asked me to talk about inflation. More than happy to talk about inflation, although inflation is not my favorite subject to talk about. It's probably one of the most insidious and the most destructive economic factors that affect individuals and industries and economies. It's very distortive. It's monetary based. In most cases, it's usually originated from an over accommodation of money printing by the central bank or central banks, which this is what we're going through now is a perfect example of that. But that coupled with this disruption in the global supply chains due to the pandemic, due to antagonistic trade policies by the Trump administration, and due to the war between Russia, and Ukraine, have set in motion exogenous and endogenous factors that have had a significant impact on the price of goods and services. Inflation, unless you're hedged against inflation, obviously, real estate, gold, and other types of commodities will provide you with some type of hedge, not a perfect hedge, because there's always going to be basis risk in your hedges. But hedges are not long-term in most cases. They're usually a short-term hedge, and the hedges are usually pretty expensive to be able to hedge off inflation. So inflation really needs to be addressed at the monetary level through the central banks and central bank policy, i.e. Interest rate hikes. And also the inflation needs to be addressed by the fiscal policy side, or Congress and the executive branch, through higher taxation and through supply side policies. That will help significantly. Unfortunately, Congress and the executive branch, in my view, are not very smart individuals in most cases. I don't know if they have bad economic advice from their advisors, is the reason why they lag in their policy responses, and in some cases the policies are not perfect in their ability to solve problems such as inflation. But I think the attempt at inflation through the last Biden policy that was negotiated between the two parties and passed recently will have some effect on some prices, such as drugs and some other areas that will have a positive impact on trying to bring down the inflation rate, but won't bring down the inflation rate wholesale, you really need supply side policies and trade policies to be able to allow for a free flowing of goods into the U.S. At lower prices. But inflation is an issue across the globe. And thank God we're not in Turkey or in parts of Europe or Eastern Europe or in parts of Asia and Latin America where they're seeing inflation rates of 30 to 50 to 100. You've seen inflation rates in Venezuela over the years of 1,000,000%. Unfortunately, what inflation does is it deteriorates your real income, your real returns. So if you're getting a return of 10% and the inflation rate is 11%, you're getting a negative 1% real rate. If your wages are growing at 5%, but inflation's at 10%, your real wages are declining at 5%. And I just read yesterday that the UK's real income growth is basically collapsed and is at the lowest level in 40 years. So basically they're seeing negative real wages that they haven't seen, before World War II. So we are in, unprecedented, situations. The disruptions in supply chain through antagonistic policies and disruption in supply chains, particularly out of Southeast Asia and particularly China, due to the shutdowns in Wuhan, in Shanghai, in Guangdong, in those areas, has had a major impact, on the ability, of China to be able to produce goods and export those goods cheaply across the globe. They've actually the GDP growth rates for China were revised significantly down to 3 to 5%. And that actually caused gold prices, which is usually a hedge for inflation, to drop 1.1% in one day last week. So usually countries and individuals buy gold as an inflationary hedge because it is the prices are positively correlated to inflation rates. They're not a perfect hedge, but people use that as a hedge to hedge off the deterioration in the purchasing power of their currencies. What's interesting is that foreign currencies have depreciated and have been devalued significantly over the last year to allow their goods to stay competitive in the global trade markets. And due to unrest and uncertainty around Taiwan and the South China Sea and in Russia and Ukraine and Eastern Europe, there have been massive capital flows out of Asia and out of Europe into the US dollar, causing the dollar to appreciate and the dollar to reach almost all-time highs against foreign currencies. That there's actually a positive component to that, in that if foreign countries that are export-oriented actually devalue or their currencies are depreciated, that makes their goods cheaper in the global trade markets. And since the United States imports more than they export, that could hold some downward pressure on inflation in the United States as the supply chains come back online, which they have slowly. That also will help improve and bring down the inflation rate, which I believe it has, but just marginally, not significantly. But the disruptions in the supply chains do need to be addressed at the national level through more accommodative trade policies, which I haven't really seen as of yet. We've seen the home price and rental rate inflation rates. We've seen home prices appreciate at 20% per year over the last 2 years, causing a housing crisis with really no response at the federal, state, and local level to enact supply side policies that would help alleviate and bring supply into the marketplace to try to alleviate the shortages and the affordability crises that's currently occurring. We're seeing rising mortgage interest rates, although mortgage interest rates have come down, and I'll talk a little bit about that in a second. But we've seen home prices appreciate significantly. We've seen mortgage interest rates come up significantly over the last year, which has cooled the housing market. And I'm hearing, as of this week, we've been hearing for a few weeks that sales and permitting the new construction of homes have dropped off significantly, over the last 6 to 9 months. And we're now hearing that asking prices for homes in core submarkets in the Bay Area are starting to correct, and price adjustments are actually starting to occur at that upper level, of the housing market, as it should, because those markets were inflated due to low interest rates and due to the migration of individuals working from home has put abnormal amounts of demand on housing. The other way to address inflation, unfortunately, is through higher interest rates by the Federal Reserve. In most cases, the Federal Reserve will raise short-term interest rates, or what is called the federal funds rate, by selling bonds in the marketplace, driving down bond prices and driving down interest rates, mainly on the short maturity end of what is called the yield curve. And that has been occurring. And actually, the Fed goes to Jackson Hole next week to debate inflation and interest rate policy. The consensus is that the Federal Reserve will raise interest rates either from 50 basis points or a half a percentage point to a whole percentage point, depending on what Fed governor you talk to or president of the one of the 12 Federal Reserve banks. They have been giving interest rate guidance over the last month. And if you believe Mary Daly, who is the president of the Federal Reserve Bank of San Francisco, and Raphael Bostic from Atlanta, and Coach Kari from the East Coast, they say definitely that they will raise interest rates at least 50 basis points. That's already been priced into the market. If they do a 75 or 100 basis point increase in short-term interest rates, that will signal the market that inflation is running higher than we anticipate, and they're going to need to become more aggressive in raising interest rates to bring down aggregate demand to become more in line with aggregate supply, i.e., if the Federal Reserve continues to raise interest rates over the next 6 months of at least 50 basis points, the yield curve, which is the maturity of the bonds by interest rate. So each maturity, 3 months, 6 months, 9 months, 12 months, 3-year, 5-year, 7-year, 10-year, 20-year, 30-year, whatever the maturity is, there's an interest rate associated with those maturities. That's called the yield curve. The yield curve is normally upward sloping due to future inflation expectations, but the yield curve has flattened because the Fed has been raising interest rates to cool the economy, to cool inflation. Well, the yield curve is now inverted, and it has been inverting, which means short-term interest rates are higher than long-term interest rates. And I've gone back 150 years, I've gone back 80 years, and looked at the data, and every time the yield curve inverts persistently, we are in a recession within 24 months, guaranteed with a 90% probability. So the yield curve did start to invert earlier in the year, which basically states that we should be approaching a recession unless the Fed starts to lower interest rates at some point. We'll probably be in a recession within the probably the fourth quarter, but I was forecasting probably the first to second and maybe third quarter of 2023. So a recession scenario, hopefully not a severe recession scenario like the financial crisis of 2008 and 9, but hopefully a technical recession, which are usually what the Federal Reserve had engineered post-World War II, starting in the 80s and the 90s and 2010 period. So for quite some time, the Fed was actually able to manage the economy fairly well, to create and engineer mild technical recessions that last. The troughs usually last on average about 12 to 24 months. And then we pop out of it because they lower interest rates relatively quickly. It doesn't damage the economy or the labor market too much. And the economy then starts to grow and recover and start to get back, into its natural growth path phase. And we're usually in that phase for probably another, 5 to 7 years, on average. My research has also identified that we usually enter a recession in the first 5 years of every single decade. So we're basically right on track for my predictions. And then we're usually in the growth peak phase of the business cycle in the last 5 years of every decade. And it looks like that's actually going to play out again. The question will be, as the Federal Reserve raises interest rates to address the inflation issue, will higher interest rates and the higher appreciation and revaluation of the dollar raise a dollar denominated liabilities on a global basis to the point where sovereign countries will start to default on their bonds, and we will have a sovereign bond crisis across the globe, which is highly probable, which would cause a lot of distress. So not only do we have a recession issues, we have inflation issues, we have potential sovereign bond crises, and geopolitical risk emanating out of Asia and emanating out of Eastern Europe. So that's kind of my overall, as I call data dump, from my brain to you guys. So what I'm going to do is I'm going to jump online here. Can you get my screen? Can you guys see my screen?
We see the just joining Zoom demo. We do not see the actual website.
Okay, perfect. I'm going to get out of here because I don't want you to see my emails. Got it. Okay, can you guys see the, I'm bringing up right now. Hold on. Okay, can you see my my screen right now?
Yeah, now I can see the Bureau of Economic Analysis.
Okay, perfect. So I'm just going to go through some economic indicators here. The Bureau of Economic Analysis is a great place to go for data. I can go very quickly and look at gross domestic product. The theory basically states that if the gross domestic product is negative for 2 quarters, that we're in a technical recession. Doesn't mean we're in a recession, but it means that technically we are in a recession. The first quarter negative GDP was really the consumer consumption, government purchases, business investment stayed relatively healthy in the first quarter. What really pulled the GDP negative was net exports. We had sucked in so many imports because of pent-up demand after the pandemic that we didn't have enough, domestic supply to meet all of our demand. So we had to suck in, major imports that made our trade deficit, expand very rapidly. But I don't think that's a bad thing. Just as long as we're importing cheap goods and not expensive goods, it will have a positive effect in holding down inflation, although it really didn't. But it was negative. And then this last quarter was also negative, not significantly, but was negative. And that was actually negative, not only due to negative net exports, but also we saw deterioration from the consumer, from government purchases and business investment. So that looked more like the beginning of of a recession, even though, those factors have held up. They're trending downward, and I believe that we may actually see a negative quarter in the third quarter, although, we won't know until probably October what that really is. But we have seen an improvement in consumer confidence within the last month, employment job growth in the last month of over 500,000, unemployment at cyclical lows, again, which all bodes well for a growing economy. But again, but we'll see what happens as the Fed continues to raise interest rates and as inflation starts to cause people to pull back on their purchases, because inflation is causing their real incomes to basically collapse. Particularly the middle and the lower class are getting completely hammered by inflation because they just haven't seen the wage increases, and they just don't have the budgets to absorb the inflation, which is unfortunate too, because my prediction is that because of this bout of inflation, and if it's not addressed quickly through supply side policies, but if it's really addressed through raising interest rates to engineer a recession in combination with inflation, which is called stagflation, will, along with rising rents and housing costs and lack of affordability, will probably drive more people into homelessness. And you think it's bad now as you drive around and see people all along lakes and rivers and tributaries and under freeway underpasses. Just wait. If this continues, as I believe it will, there will be more and more people that will be thrown into the streets and become homeless and start to resemble third world, economies from that viewpoint. Let's go back to Bureau of Economic Analysis is great. I like to look at personal income. Actually, personal income, has been increasing on a nominal basis, again, which is positive. But again, when you subtract out the inflation from the increases in personal income, they are negative, which means that real income is actually falling, which means that standards of living are falling in the United States and have to be addressed. Here's the trade in goods. Here's your trade deficit. As you can see, it got pretty high, and then it started to come off as our exports basically stay constant. It's just we're importing less because the consumption and government purchases and business investment is starting to fall because of higher interest rates, and people are consuming less in anticipation of a recession. The same thing with businesses. Businesses are starting to announce job layoffs. Nothing significant to affect the unemployment rate. But my question will be, once the Fed is done addressing inflation, and if it doesn't see inflation move down fast enough towards its target, it will start to target the unemployment rate and start to push rates higher and start to engineer mass job losses to try to push up the inflation rate, to try to push up the unemployment rate, to try to push down the unemployment rate. So, push up interest rates to push up the unemployment rate, to push down the inflation rate. Excuse me, I apologize for that. So the Bureau of Economics is a great location to go for just quick indicators. I also like the Bureau of Labor Statistics. This is a great website to go to, www.bls.gov. I like this site because I can go very quickly and look at consumer prices. It looks like the consumer prices were unchanged in July, so that's positive. But on a year-over-year basis, it's still running around 8%. Unemployment rates of 3.5 are cyclical lows. The payroll employment numbers in July were over 500,000. That was actually a surprise. We were forecasting about 250,000 jobs created, so it's basically double economist expectations. Hourly earnings are still continuing to go up because unemployment rates are still low, and people are still continuing to leave the labor force. Gen X is leaving, the boomers are leaving due to retirement. Some people are giving up on payroll employment and starting to start their own entrepreneurial efforts. So that due to technology and other aspects, people are rethinking working in an office, working on a payroll. They're rethinking work altogether. Producer prices actually fell, which was good, but they're still up at least 8% on an annual basis. As you can see, employment costs are still rising significantly. This is on a quarterly basis, but still, that's going to continue to put upward pressure on employment costs, which will then be transferred onto consumer prices as companies try to continue to maintain their margins and their profitability. So that will be passed on to the consumer, which is inflationary. Productivity is actually negative, which means that companies and firms have basically wrung out all of the productivity available from their existing workforce. So they're going to need to either hire. Negative productivity is also bad from an inflation standpoint. If your workforce is not productive, it means that the costs of employment are starting to hit your profit margins, and you will then transfer those costs onto the prices of your goods and services. We are starting to see prices of imports start to fall, which again is deflationary or disinflationary. Exports are starting to come down too, which again is disinflationary. However, for the last 5 to 6 months, these import prices were very high. So we are starting to see some relief on the inflation front. The question is 1 month is not a trend. 3 months is a trend. So we will continue to monitor these economic indicators to see if these effects on inflation through the indicators are actually a trend and not just 1 month random data point. I also just like to go in here and click on this graph. And I like to click on this little button here, and I like to go back. This is the CPI. So actually what I like to do is I like to go to this one right here, more formatting options, and I like to look at 12-month percent change here, and I like to go back, pretty much as far as I can, to look at annualized inflation to get an idea of just relative inflation based on history. So you can see that the annualized inflation rate that we've been basically confronting is around 8%. Well, we haven't seen 8% inflation rate since basically the early 1980s, late 70s. And you got to remember, during this time period, we had the war on poverty and we had the Vietnam War that we were fighting. So I guess you could say that the over-accommodative monetary policy that the Fed implemented in 2008 and 9 to fight the financial crisis, and the over-accommodative monetary policy and fiscal policies to fight COVID depression has now been manifested into the inflation rate. The question will be is how far will the Fed raise interest rates to bring inflation down, as Volcker did in the 1970s and 1980s. And remember, Volcker, God bless his soul, was ruthless in his attempt at killing inflation and inflation expectations, bringing interest rates down, anchoring them at a low rate, bringing the value of the dollar down to make the dollar and American goods competitive on a global basis. And we basically went into a disinflationary secular trend from basically where they peaked in 1990 all the way through to basically COVID. And then we saw this spike due to supply chain disruptions and due to over accommodated monetary policy. The Fed basically totally blew it. They totally screwed it up. They should have been basically pegging interest rates to GDP, but they didn't. They left the interest rates too low for too long. They thought inflation was going to be transitory. It turned out that it wasn't transitory, and instead of being conservative and raising interest rates earlier at a slower rate, they've now had to come in and be more aggressive. Now, this isn't anything new. The Fed has done this over and over and over again throughout its history. It's just the way they do things. They constantly make policy errors. And my concern is that because of the policy errors, along with their persistence to keep interest rates low too long, that they've lost credibility in the marketplace. And because that now the Federal Reserve owns a significant portion of the total outstanding debt of the United States, it's not an independent agent that regulates the economy. It is now an arm of the Treasury. This is major philosophical and major political and economic ideological issues that we are actually having to confront, and it could be existential. And this is what a lot of my colleagues and a lot of businesses leaders are talking about if they've ever studied economics. Okay. Oh, I wanted to go back to in this website, which I think is kind of cool too. What I can do very rapidly is when I go to the BLS website, I can go to the West. This is really good. So I can go to the West. This gives me the Western region. I can click on California, and I can basically get economic indicators for California. So you can see the unemployment rate is trending down. You can see non-farm employment growth looked like it peaked in February and is starting to decelerate. Here's your tech sector right here, still running healthy, but not as high as it was earlier in the year. And we've heard announcements of layoffs from Apple and some of the other businesses. It's not wholesale yet, but we've heard layoffs at Coinbase and Apple and a lot of the tech companies, which will affect your rents and potentially even the prices of homes in Mountain View, Sunnyvale, Cupertino, the core, tech-centric areas. But I like this graph. What I can do too is I can go over here and I can go down to San Jose. I know, Monica, you have a lot of your clients in the South Bay. So I can go to San Jose, which is basically Santa Clara County.
Yes.
I can quickly look at the unemployment rate. So you can see it's starting to trend upward. So that's obviously going to be some tech pressure. Looks like employment growth rates are still holding up. Let's look at tech. Looks like tech is actually doing quite well. There might be an actual lagged effect in there. So I like to look at that. I like to look at the graph. So I can look at the actual, this is how destructive the pandemic was. And you got to go back, to, the tech bust, right? The post-tech bust. So you can see it was more severe, was the tech. And you were able to recover a lot quicker. So you're almost where at the employment levels, you're almost back to where you were, or you're actually back to where you were prior to COVID. Okay, so that's always good, right, for rents and home prices and stuff. So I like to use this website because I can quickly get to some statistics. I also like to look at the conference board and look at economic indicators and consumer confidence. You can see consumer confidence is negative here. That's actually a negative. Help wanted ads online is positive. That's good. Leading economic indicators, that's negative. That's not good. And then you can see, across different countries, where the economic indicators are. But I like to look at consumer confidence, because consumer confidence is a leading indicator. So you can see, it recovered, was actually peaking right before the pandemic, then collapsed. It looks like it recovered to basically almost pre-pandemic level. And then consumer confidence has been in a downward trend, which means that there's anticipated unemployment and inflation probably had something to do with that. And consumers are probably thinking that, there's a pending recession or a possibility of a recession. So therefore, their confidence levels are starting to come down. So I like that indicator too. That's a leading indicator. I don't have car sales. That's a good one. And auto parts sales is also another leading indicator. I like to go to the Organization for Economic Cooperation and Development. Also, I can get a lot of charts. This is the Business Confidence Index. So you can see that that's coming down. I can also look at leading indicators. You can see that that's coming down. So again, these are trending down, which basically means that businesses and production and indicators are starting to decelerate, which is usually an early warning sign for a recession or a potential recession. I don't know the severity of it, but I'm hoping it will just be technical, short, and shallow. The other issue that we need to understand is a geopolitical risk. And we have to understand really the Russian invasion of Ukraine. And I want to look at the graph here. Here's basically the oil and gas pipelines that are emanating out of the Russia. Now, these pipelines were developed over the last 30 years after the collapse of the Soviet Union in 1989. Then, as Russia basically through perestroika and glasnost and started to open up, to the West and tried to modernize its economy using capitalistic principles. Unfortunately, the severity of their recessions thereafter, the economies opened up, led to a severe devaluation of the ruble, a severe economic hardship, on their population, which actually caused Russia to try to modernize quicker. But what they did is they did not go towards market capitalism. They actually went towards autocracy and oligopolies with oligarchs basically controlling individual industries and sectors of the economy. That basically has it's a different industrial structure, than you see in Europe and in the United States that are more pure laissez-faire capitalism or neoliberal capitalism. But they did open up their economies. They did modernize. They did look towards the West for trade. And since Russia has a comparative advantage in natural resources and oil and gas, they had developed, with help from the West and investment from the West, to basically build oil and gas pipelines to feed energy into Europe. And you can see how the tentacles basically move right into Europe. Well, unfortunately, there's two factors here. One, now Russia has a comparative advantage or a hold that is basically holding Europe in a prisoner's dilemma, because if Europe basically becomes antagonistic, which it has through its NATO expansion, and has become antagonistic due to embargoes and restrictions on their imports, Russia has retaliated by reducing significantly oil and gas pumped through their pipelines into Eastern Europe and into Europe, particularly in Germany, which is one of the largest export-oriented economies in the world. So because of the shutdown and because of the pullback of oil and gas in Europe, oil and gas prices in Europe have skyrocketed, creating hyperinflation, recession, and collapsing standards of living in Europe. And we're not even in the winter yet. Winter will be horrific for people in Europe. because they cannot replace or build pipelines from the North Atlantic, from Sweden, Denmark, Finland, from the North Sea, to basically feed energy into Europe fast enough, because it takes at least 10 years or decades to build that kind of capacity. So that was probably the strategic mistake that Eastern Europe and Europe made by becoming dependent on an autocratic, authoritarian, oligopolistic, oligarchic state that has now been basically controlled and run by a demagogue, i.e., Vladimir Putin. That's causing inflation, which is being exported. Now there's also inflation too, because as you can see, Ukraine on the Black Sea was actually the breadbasket, not only of Europe, but also of Northern Africa. So since the Russians basically embargoed and took over Eastern Ukraine, which is basically the most productive, it's where the military bases are, it's where the manufacturing bases, it's where the agriculture is, their breadbasket. They have basically taken the economic heart of Ukraine and now basically own it and have taken it. There's nothing coming out of there. There is no exports of minerals, no exports of energy, no exports of agriculture, which has caused more inflation. And until we resolve the Eastern European war issue and reconciled with Russia in some type of peace treaty, inflation will continue to basically pummel Eastern Europe and the rest of the world. All right, so let's also look at supply chain issues. Now, I don't have a graph here. I was looking for the supply chains. Oh, I do have one on the next chart of the supply chains on a global basis, so we can get an idea how interdependent we are with not only Europe, Latin America, Africa, and Asia in regards to global trade. The global trade system that was basically put in place after the 1970s, after getting rid of Bretton Woods and negotiating free trade zones and free trade treaties in the 80s, had a major impact on keeping inflation low, because we were all importing and exporting from each other at lower costs. So basically, trade theory actually worked very well for decades until originally starting with Donald Trump, that attacked PPP, attacked NAFTA, left PPP, basically renegotiated NAFTA, left the WTO, renegotiated our trade treaties with Europe, and basically started to completely distort the free trade system that had basically taken 30 years to build. And then the pandemic came and basically broke the system. And you can see here where in 2020, here where the supply chain had been completely disrupted. It is starting to come back online, particularly in Europe and the US, but has been impaired, as you can see, in China and other emerging markets. Here's the supply chain graph that I found. This is just sugar trade. Let me see if I can find one for total global. Well, this is probably a good one. Okay. Oh, so this is still. Okay, I'm looking for. Okay, here we go. So here's the world shipping routes right here. So you can see pretty quickly where the majority of the trade comes out of. So between Africa and Europe, there's your natural resources. Here's oil. You can see out of the Middle East through the Straits of Hormuz. You can see the interdependency in trade between China and Southeast Asia, and also into the United States, particularly the ports of LA and Long Beach, the ports of Seattle, the ports of Oakland, and then obviously through the Panama Canal, these supply chains have been significantly disrupted due to reworkings of the trade policies and due to the destruction of the pandemic and shutdowns out of Southeast Asia. Let's look at the housing market. I'm going to kind of jump around a little bit. This is the Case-Shiller index. You can see what housing prices did in 08, 09 and what they've done recently. They were actually in a fairly nice linear constant growth, and then the pandemic hit and everybody started buying homes. They basically repaired their balance sheet, so everybody qualified for homes. People had down payments. Interest rates basically and mortgage rates collapsed and became very affordable. People were moving out of urban core areas in the secondary, tertiary markets. People were moving out of urban areas and moving out of rental apartments into homes in the Central Valley and into desert mountain states here, into Texas, into Florida are good examples. And people went to where they could buy more land and buy more house, and for the same price as renting. And Mountain View at $3,000 a month, they could buy a 3,000 square foot house in Boise, Idaho, or Salt Lake City or Phoenix or Texas or Houston or parts of Florida, or even if you wanted to go into the South and Nashville and other parts of the U.S. So housing markets here, and I'm trying to see if I can get the percentage change here. If I can actually get run rates. Oh, here we go. Percentage change. Got it. Let's look at the percentage change. Okay, see if that does anything. Let's apply all that stuff. Oh, here we go. Here's the percentage change. Perfect. All right. So here you can see the volatility, in the index, but it's in an upward trend. Then it flattened out, and then you can just see how steep the trend was. It was basically similar to 2002 to 4, and you probably got to go back to the 80s to see that kind of slope. But you can see there's some volatility, some seasonality here. But it'll be interesting to see if this trend continues in a downward path. Here is another thing that I think is very telling. I typed in my URL. I typed in the Fed's balance sheet. So here's the Federal Reserve balance sheet. So the Federal Reserve printed money and bought bonds. After the financial crisis, right before the financial crisis, the Fed had about, let's say, 900 billion on its balance sheet. And actually, the Fed for decades had about a quarter of $1 trillion in government securities, and where they would just buy and sell bonds in the open market to regulate interest rates, to regulate the economy. But it wasn't until the financial crisis, until the Fed started using unorthodox, extreme accommodative monetary policy to clean up the mess, from the financial crisis, that they started printing money. So they went from basically $1 trillion to $2 trillion in basically a year. And then by, it looks like 2011, they were at $3 trillion. By, it looks like 2014, they were at $5 trillion. And then they actually tried to unwind the balance sheet. That created a stock market convulsion because everybody was addicted to low interest rates, created volatility. So they had to step back in. And then obviously due to COVID, they went from 4 trillion to basically 7 trillion. And it looks like the balance sheet peaked at 9 trillion. And it looks like the Fed is starting to unwind its balance sheet, which means it's selling off bonds, driving down bond prices, and driving up interest rates to cool the economy. If you overlay the stock market index, the S&P 500, it's highly correlated. And eventually the real estate prices will also be correlated to the Fed's balance sheet. So this is a really good predictor too of stock and bond prices. This is the money supply growth rate. So this is the amount of money that the Fed has pumped into the system by printing money, buying bonds, driving up bond prices and driving down interest rates. And you can see that the Fed is starting to slow the printing of money because it's inflationary. Okay. Oh, and this is a good place to get some other economic indicators. You can look at GDP. You can look at GDP from construction. That's a good one. So you can see construction has dropped off significantly. In the United States, you're seeing it in permits. You're seeing it in home construction. You're seeing it in value put in place by commercial, but really construction has dropped off significantly on the residential side. What else? Oh, I also like to look at, here's another money supply. So what we try to do, or what I like to see, is the Federal Reserve pegging the money supplied to GDP growth rates. That's kind of a rule of thumb that I think is that's actually a pretty good rule to basically regulate the economy to prevent inflation from getting out of control. But you can see that the money supply growth rate is still running well above the current GDP growth rate. It was extremely high before, and it was really high during the pandemic. This is inflationary, okay? Because the theory goes by Milton Friedman that all inflation is monetary. So basically, it all emanates from the Fed. Usually, the Fed makes some mistakes, prints too much money, creates too much inflation, comes in, starts to sell off the bonds, drive bond prices down, interest rates up too fast, too far, inverts the yield curve, and engineers a recession every freaking time. So it's pretty persistent, and the Fed's basically on track. Another indicator that I like to look at too is the velocity of money. This is the M2. M2 is basically currency in the economy along with near cash, like your money market mutual funds and stuff like that. It's the number of times the currency circulates in the economy. It's like an inventory turnover ratio. And you can see that the velocity of money peaked in 1997. That was basically the last real economic peak, in my view, due to real economic factors as opposed to monetary factors from the Fed. It was due to, technologicalization, introduction of computerization, macro computers, the internet. And you can see that the velocity of money due to substitutes for currency, cryptocurrency in the over the last 10 years, hedge funds, shadow banking, open flows of cash and cash flows on a global basis. You can see the velocity of money was in a secular downtrend and then basically collapsed during COVID, and then bottomed out. And you can see that the velocity of money broke through its historical supports, and we're in basically uncharted territory. And then COVID just collapsed it. You can see velocity of money is starting to improve here, but it's just a blip. It's really important to understand velocity of money, because velocity of money is highly correlated to employment rates and real income growth rates and labor participation rates. So basically, it tells us that the economy is severely impaired and is not functioning directly. And the Federal Reserve has no impact whatsoever on the velocity of money. And since it's it's highly correlated to labor and labor policy, and the inability of labor policy enacted currently by Congress, the economy will probably go forward well below its long-term potential because Congress can't get it together to pass comprehensive labor policy, which is actually needed, particularly when it comes to educational supports for college students, and job retraining and skills retraining. We don't have industrial policy like that in the United States. We have to pay for the majority of our college education, which basically prices out a lot of people from even obtaining college, or it burdens them with huge, massive student loans on their back, which is not good. It also limits access to education, and we don't really have an industrial policy to retrain workers that have been displaced by, financial crises or pandemics to get them back into the labor force. So we have some major structural issues. What's the next one here? This is labor participation rates. Perfect. So as you can see, during the 60s, labor participation rates were really low. Then the economy started to modernize. Then women started to enter the labor force. Thank God. And basically labor participation rates started to increase. Well, labor participation rates are also highly correlated to real GDP levels because we're producing so much, we're consuming a lot, and basically the overall economy is growing in real terms. But you can see that labor participation rates have started on a secular downtrend. The question is, why is that? Well, one is fewer people are getting education, fewer people are getting training, more people are underemployed or unemployed, people are leaving the labor force due to age discrimination, incarceration. We got a lot of issues. And then it actually looked like labor participation rates were actually recovering due to the entrance of Gen X and Gen Y. We're graduating from college and actually pulling up labor participation rates, but labor participation rates were falling for women and falling for particularly men between the ages of 45 and 65 years old, was holding it down. And then COVID hit. The majority of the people who left the labor force, 2 million women left the labor force, and only 1 million people have come back into the labor force because they've been disrupted in their careers, disrupted in their jobs. There is no child leave policy. They don't get enough maternity leave. There's a lot of issues that is really holding back labor participation rates, and will always continue to be well below. I'm going to do some research and figure out what the GDP contribution of labor participation was here, and basically write a paper on the loss of GDP and wealth and social welfare in the United States due to lack of employment policy to address the labor participation rate issue. Not even talked about by Congress. Okay. Semiconductor sales. This is a major indicator for Silicon Valley. As you can see, revenue, for semiconductors has been in an upward trend. I would probably log this to get a better view of the real change in semiconductor revenues, but this is positive. This is on a global basis. So we'd have to really segment it by geography, particularly Asia compared to the United States. But still, you can see that the trend is upward in absolute terms. This is probably, there's some inflation push in here, so I would probably inflation adjust this to get a real view. But you can see here that there are some negative indicators of year over year percentage change in semiconductor revenues, which means that the tech sector is actually starting to contract, which will put downward pressure at some point, probably on rents and home prices in the core tech sectors. Let's look at, what's this one? Oh, venture capital flows. Okay, this is another indicator, particularly in Silicon Valley. And as you can see, funding peaked out in the fourth quarter of 2001 and has been in a VC is now starting to decline. Well, the tech sector is seeing it. Tech sector is starting to pull back. Revenues and cash flows are starting to pull back. Stock prices have corrected. VC is starting to be pulled back. So you'll start to probably see that at some point in announced layoffs in the Valley, higher unemployment rates, lower employment growth rates, because VC is actually a leading indicator. Monica, how am I doing on time?
Well, we are pretty much, like almost time for Q&A. But then if
Okay.
you want to wrap up, some of your observation, yeah, we'd be very happy about that.
Okay. Okay. Well, let me just spend 3 more minutes. So here is economic indicators now showing negative. Here is direct investment in the United States. Again, you want to look at those and to see the flows. Here are imports in the United States. You can see those are starting to come down. Exports are increasing. Let's see. You're seeing the foreign currencies start to depreciate, US dollar appreciate. That could be indicators of a slowdown globally in capital flight into the United States. Let's see what else. Just going to quickly see if I can get through these. Here's the Dow Jones year to date. So that was your 10 to 20% correction, but July was one of the best months that we've seen prior pandemic. Here's your NASDAQ, again, affected by the tech sector. Here is crude oil, now starting to come down. This was major inflationary pressure, going from $3 a barrel to $6 a barrel. It's now starting to come off due to increased supply and lower demand. Gold has actually taken a hit due to lower inflation expectations and the revision of GDP out of China. You've got treasury yields that went up significantly since the pandemic. It looks like they're hovering. This is the 10-year treasury running around 3%. Add another 1.5% on it, and there's your mortgage interest rate of 4.5%. So I use the 10-year to track mortgage interest rates or forecast them. Here's Bitcoin, totally has been, in a major correction, probably not seen since 2018. Not saying it's a good time to get back in. Here's new residential construction. You can see that starts are starting to come down in permits. I talked about that earlier. Here's new private housing units. Still looks pretty good. Value of new construction put in place. You can see that that's negative. There's your commercial side. I also looked at NAREIT. If anybody wants, I would go up to NAREIT and look at REIT Watch. Great place to get a bunch of economic indicators. An awesome report from the public markets, from the REIT sector. I also like the Mortgage Bankers Association. I like to go in and get their data book. This is an awesome report. It has tons of economic indicators, mortgage markets, real estate, mortgage flows. It's freaking unbelievable. And then I'll finish up here. I like to go to CBRE. It's insights and research to get the commercial real estate market reports and trends. I love this place. I also like to go to Cushman Wakefield to get my commercial real estate data. Again, I go into insights. They have a ton of research reports and research reports by markets. So I can get industrial, retail, apartments, office, life science, data centers. I can do the same thing with Jones Lang LaSalle. I can do the same thing with Colliers International. They give away free research too. I can go to Newmark Knight Frank, another great place to get some really good research. I like to go to Marcus and Millichap, Hassan Naji and his group down in Palo Alto, but they're national, great free research. And then Real Capital Analytics, which was bought by MSCI. This is a good resource, although you got to pay. Moody's Analytics, they bought Reese Reports. That's another good place. And I don't have CoStar up here, which is another good source. And the National Council of Real Estate Investment Fiduciaries is also a great place to get public real estate market price and return trends. Okay, I'm going to end it there.
Yes, thank you. Well, that's a phenomenal amount of information and very good tools for our future research and analysis. Thanks so much, Larry.
Yeah, you're welcome.
Yeah, so we do have a couple questions now, and we encourage everybody, if you have questions, please start typing in the chat box. And so Larry can address it, and hopefully, like we have a number of questions that we would be able to address within about like say 30 minutes or so. So the first question comes in from Khalid, and Khalid's question is,
how are you, Khalid?
Yeah, what is your opinion?
Nice to see you again.
You know Khalid, right?
Yeah. Nice to see you again.
Right. He's
thank
a
you.
long-term supporter. So what is your opinion on the real inflation rate? And what is the Fed is reporting is about 9% or so, but we know that it might not be, comprehensive. Like, yeah, right.
That's a good point.
Energy and food. So what do you think about the real inflation rate? Are we heading towards a hyperinflationary environment?
Well, the inflation rate is higher than what's being reported. Okay. And we all have individual inflation rates based on what we consume, right, within our consumption budget. We've all been, confronting, even though the Federal Reserve is targeting inflation at 2%, we know inflation is running real inflation is probably running between 5 and 10%, because the Federal Reserve doesn't do a good job of capturing housing costs, healthcare costs, or education costs. And anybody who's had kids, and have been paying for their kids, education and paying for healthcare over the last, 10 to 20 years, those inflation rates have been running at least, 5 to 10%. And I know my healthcare bills were increasing at 10%. My premiums were increasing at 10%. So it really depends on what your consumption basket is. But if the Fed is reporting inflation at 8%, I'm probably thinking it's probably, between 15 and 20%. And you go to the store, I do the, peanut butter and jelly index. It used to cost me like $3, $4 to buy a jar of peanut butter. Now it costs me $7. It used to cost me $3, $4 to buy a loaf of bread. Now it costs me, $6. The jelly used to cost me $3, $4. Now it costs me $5, $6. So, just, using the peanut butter and jelly index, you've seen significant, inflation over the last, 2 years, but also inflation over the last 5 years. So the inflation rate is running significantly higher than's being reported by the consumer price index or the producer price index. And I always like to add more to it or even double it to get a true vision of what the real inflation rate is, particularly in high cost areas like Northern California, Boston, maybe Seattle, definitely LA, and definitely New York and Washington, D.C. are extremely high cost, in Boston, high cost geographies. I don't know if Khalid, I answered your question.
I think that should be able to address it because it's very comprehensive. So the next question comes from me. I do have a couple of questions. Regarding the recession trend, if we're going into recession in 2023, next year, how long do you think it will last? Because I remember you always say that there's going to be a cycle. How would it impact the Bay Area in terms of jobs and real estate trend? Because like many of my clients, of course, if they bought a home at the peak time, which is before April of this year, so they've been paying maybe like say 15, 20% or even 30% higher. So when do you think, how long, this trend, this kind of stabilizing trend will last? And also nationwide, because you provided, many good real estate sites, and I'm sure that you've been researching on it. What are the cities that you think will witness major growth and gain from this economic climate?
Okay, well, there's a bunch of questions there, so I'll try to address them one by one. I think we have to put it in retrospect. I mean, if you've owned or held your home over the last 10, 20, 30 years, you're still going to probably get 5 to 10% in the Bay Area home price appreciation rate, coupled with your mortgage interest deduction. I mean, you really can't complain if home prices in high priced areas correct by 10%. That's a no-brainer. That's not an issue. If you bought at the peak of the cycle, then that's an issue, right? Because you're looking at probably a 10% correction, but it's not enough to short sale. You're still getting the mortgage interest deduction. And you're getting, if you do eventually sell the home and there is capital appreciation, depending on if you're married or single, you'll get the $250,000, $500,000 capital gain shield. So, and plus you get to live in a home and enjoy the services that a home provides, the safety. And if you bought in a good location where you have good schools, the home is going to continue to have a floor underneath the pricing and will probably appreciate over the long run. So, it's usually asset price bubbles and housing bubbles that we have to confront. We were probably in one due to the pandemic. Now that the Fed is raising interest rates and people are now looking towards either moving back, and going back to work, that may people may rethink, where they want to live, and maybe want to be closer in to the CBDs. But I think the CBDs are probably permanently impaired, particularly San Francisco. I think there will be a floor under pricing, but San Francisco is significantly impaired. You got issues in downtown San Jose, obviously, and some other, urban areas like downtown LA and Seattle. Those urban cores, have been extremely disrupted, by the movement out of the urban cores because of, lack of attention to homelessness. You have increasing crime. You have, overpriced housing. So you got a lot of corrective issues that will probably affect those home prices more than areas in suburban locations. So obviously suburban locations, I would say in the Central Valley, even though the Central Valley has seen a lot of home price appreciation, there will be some correction there. Plus you got to remember that the tenant credit and the home buyer credit is less out there. So with rising interest rates and layoffs, potentially higher unemployment rates and the dependency on agriculture could affect the Valley's home prices. But again, those prices will be propped up because people can be work from home remotely. Also markets in Las Vegas and Phoenix, even Albuquerque, Salt Lake, Boise will probably hold up very well because California has been a net exporter, of highly skilled, highly educated individuals to those markets from the time period I started tracking it in 1996. So there will always be some migration pressures that should set the floor for those markets and also set the long-term home price appreciation rates on an upward trend. The South is a different issue, although Nashville and Gainesville and obviously Miami is blistering hot, Fort Lauderdale. There's a major migration from the Northeast. It's always been there, but it's accelerating into Florida. People are migrating to Florida from California because of the tax incentives. It's a very welcoming business environment. So Florida will probably continue to see positive, home trends going forward as people continue to migrate and as jobs continue to migrate to Florida and potentially places like Gainesville and Nashville, Memphis seem to be targeted smaller metros that are seeing a lot of in-migration and population growth. I don't know if that answered your question.
Yeah, that's very good. That's very good. So, I have a question from one of the attendees. Say, is it time to buy more rental, or is it good to rate? What would be the indicators that we should be looking at, and when would be a good time?
Rental income?
Investment property.
Rental properties? I think it's always a good time to buy rental properties unless they're overpriced and the cap rates are too low. If I can buy a decent asset, it depends on if you want to do value add or if you want to buy a core asset. Do you want it just the cash flow as a basically a premium over the bond yield, with low maintenance, low deferred maintenance. I mean, that's one type of product. There's a value add product where you're going to go in and maybe put in the landscaping and redo the leasing office and fix the pool and put in some amenities and upgrade and remodel the units based on turnover. That's a value add strategy. You have to be a little bit more active and proactive on that standpoint. That takes a little bit more sweat equity, but as you know, Monica, and everybody knows down in the valley, that's always been a really good strategy if you can manage the construction and manage the asset and the leasing during that time period. And then do you hold and flip? What's your exit strategy? On that. If you can buy assets that are in pretty good shape, where you can do cosmetic upgrades to it and remodeling, and there's embedded loss to lease, which means that the rents that you buy it at are below market rents. Even though you have rent control, who freaking cares about rent control? That's all I care about is loss to lease. Just as long as I can raise my rents at a constant rate over time, if I can hold my expenses in place, I can grow my net operating income organically, over time, and let the in-place rents on the turn start to approach the market over time. It actually eliminates the volatility in the cash flows, eliminates the volatility in the valuations. It actually allows the cash flows and the valuations to appreciate at a constant rate. Rent control at the end of the day is not a bad thing if you can buy those properties, that have embedded loss to lease, and you can manage, and remodel the units upon turn and try to bring them to market, or slowly bring them to market, and don't antagonize your renters and start to antagonize local politicians that will then come down on you by imposing rent control measures and to be passed, in the election cycle.
Yeah. Good to know. So I do have a good question that come from Brian, and so maybe you can shed some light on it. He said he's a little confused on how we can be entering a recession when the unemployment rate is quite low, as shown in all the statistics. And is there a possibility with the constant media talk of a looming recession and high inflation that's causing people to hold back on spending? Or, that can be driving us in deeper towards a recession. How do we analyze this data?
Great. I took you through all of my statistics on the website. So either you can listen to the media and read it. I like to read the Financial Times. I like to read The Economist. I like to look at all my websites. I like to use Seeking Alpha, that basically gives me all of the economic indicators that are going to come out on a daily basis, weekly. You could either read the media and believe the media, or you can do your own research, or in a combination. You got to look at psychology. You got to look at business sentiment. You got to look at consumer confidence. Those are all in downward trends. Look at leading economic indicators, downward trend. You look at, yes, unemployment is low because people left the labor force. Labor participation rates are low. Gen X is leaving. The boomers are leaving. People that were blown out by the pandemic that aren't coming back, they're doing early retirement. So the labor market is basically disconnected from the overall economy because there's a labor shortage. You look at GDP, negative. Economic indicators, negative. Consumption is declining. Retail sales is declining. Inventories are rising, which again are indicators of slowing aggregate demand. You're looking at government purchases are slowing. You're looking at business investment is slowing. Value of new construction put in place. New construction is declining. I mean, I look at the economic indicators. I'm not saying we're in a recession. I never said we were in a recession. I said that the economic indicators were in a downward path. And if they continued as a trend, we are going to fall into a recession. Labor is a lagging indicator, not a leading indicator. So the last thing that'll happen is it'll start to hit the labor markets. And that's what I was saying before. At some point, as the economic indicators will start to trend downward, and if we start to see inflation start to come down, but still remain elevated above the Fed's target, the Fed will then start to target the unemployment rate, raise interest rates more aggressively, and try to engineer job losses. In the normal recessions, barring the recessions post World War II and the financial crisis, lasted 1 year to 2 years. Normally, about 12 to 24 months was the recession. And then we got into a recovery that usually lasted 7 to 10 years. The financial crisis caused the economy to go into a 4-year recession, 4 years as opposed to 2. So it was twice as deep and twice as long. It was a major disruption. The Federal Reserve and Congress learned their lesson from the financial crisis. And that's why the Fed pumped $3 trillion into the economy. And the Fed's pumped $3 trillion for a total of $6 trillion into the economy to try to get the economy back on track. They actually overshooted on all of the liquidity, which is manifested in inflation. And now the Fed is trying to raise interest rates fast enough to try to quell inflation, because inflation is destroying the middle class and the lower class, and will have long-term destructive and long-term disruptive effects on the economy and individuals and the political stability. I don't know if that answered his question.
Mm-hmm. Yeah, well, that's very complex. So, but then you are going to, like, say, foresee maybe another like recovery period, and also maybe another boom in about, like, say, 5 to 7 years. How do you see?
I'm going to stick to
like how we go back to normal.
I'm going to stick to my guns and say, if the continued interest rate path of the Federal Reserve continues, if the yield curve inverts, if the economic indicators continue to deteriorate, we're already technically in a recession, but I wouldn't call it a recession yet. And I don't think the Bureau of Business Cycle Indicators that I think calls the recession. I don't think we're in a technical recession, particularly, labor market, using the labor market as a recession, but technically we are. But if the indicators continue to deteriorate, the Fed continues to raise interest rates, we will definitely be in a recession. Probably, where are we? Probably by the fourth quarter of this year. And then the recession will probably, hopefully, if the Fed has raised interest rates enough, can start to go back in and start to lower interest rates to mitigate the damage and the deceleration and destruction in the economy in 2023, and try to bring the economy back on its growth path in 2024, probably 24, and then try to get back into a growth path between 2025 and probably 28 or 29. And then we'll probably be back in another recession in the early 2030s. It's cyclical. It's persistent. I mean, I was forecasting a recession already for 2020. We were going into a recession in 2020. We were already going into a recession in 2020. We just didn't forecast an exogenous shock like the pandemic that would send us into a depression. That was basically out of nowhere.
Yeah. It's a really good forecast, especially, for our investor. So my question is, if now you have cash to invest, I have a number of clients who exit the stock market or get big stock options, or, you have savings that you got a bunch of cash. Where would you invest now?
I did some research on Phoenix and Las Vegas. If you can handle the volatility and the boom bust aspects associated in the commodity, like supply risks embedded with those markets. I would, in getting in at a lower cost basis, I would probably maybe look at that, maybe because I think the rents will continue to appreciate there and home prices will continue to appreciate. But if we go into a severe recession, those markets are going to get hammered, and there's a lot of new supply that's coming online. It really depends on what your
Yes.
risk tolerance is, what your rate of return expectations, or is it a buy and hold strategy? Is it a fix and flip? I really, I really don't know. I mean, I
Mhm.
like I like I like good markets. Probably East Side
Mm.
Seattle. I like East Side Seattle. Probably North Seattle. Probably Tacoma because it's near the airport. I probably want to get next to universities and medical centers and research centers. Lawrence Livermore would probably be. Scripps is a good example. Hospitals are great. Any Kaiser hospital. Maybe if you can get close to Stanford, that would be awesome. But USD, University of California, Davis, a University of Utah. There's a lot of activity around those colleges and universities that I really like. Um, you know, and education's pretty resilient, and people are going back to school now in person, which I think is good. Student housing has always been good. Building a portfolio of single family homes to be rented out to students, I think is good, and have the parents co-sign and do and credit it, enhance it through that, so they basically take on the liability if the place is trashed. Um, renting to nurses and doctors in close proximities to hospitals. And I think hospitals, even though they were impaired by COVID, are probably coming back, and elective surgeries will probably be there. It looks like travel has actually started to occur. So close proximity to maybe train stations, but definitely airports. So you can buy in commodity markets, but be close to these growth poles or these employment centers that will backfill your economic and your physical occupancies during economic downturns. However, I didn't forecast during COVID that the airline industry would get pummeled, the educational industry would get pummeled, the medical industry would get pummeled. So I had to deal with physical vacancies and economic vacancies. But I think we're past it. I don't think monkeypox is going to be a major, pandemic like COVID was, and I think BA5 and BA4, COVID with the new boosters coming out will have a major impact on changing the the current COVID infection rates, the hospitalization, and the death rates significantly. So COVID will be here for the rest of our lives at probably the current levels, unless we see some kind of super mutated COVID come in and start to wipe out significant portions of the population. And I would say the only other exogenous shock that could occur that would totally disrupt our investment strategy is a nuclear war with Russia that could wipe out half of the global population.